Ladies and gentlemen, what we have here is not just another political showdown in Washington D.C., but a clear and dangerous symptom of a much deeper economic sickness festering in the United States. Today we're going to dive into the absurdities and economic realities reflected behind the latest debt ceiling fiasco. Spoiler alert, the show in Congress is merely the surface; under the calm waters, an ugly economic storm brews. And trust me, if you don't pay attention now, the ripple effects won't just stay within the US, they'll send shockwaves across the entire global financial system. Despite the usual political spin from both sides, we're quickly realizing this is not just a negotiation between two parties about whether the government stays open this Christmas or shuts down because legislators couldn't get their act together. No, the real issue here is the structural rot in the economic model and governance of the United States. Let's break this issue down systematically, because boy oh boy, there's plenty to unpack. First, let's define the debt ceiling for those of you who might not be hardcore finance professionals. The debt ceiling is essentially a cap set by Congress on how much the federal government is allowed to borrow. It's like giving your teenager unlimited access to your credit card but with a spending limit, which they keep begging you to raise once they max it out. Why do we have this system? It's supposedly to prevent reckless spending, but in practice, it's become a political football, as we're seeing now. President-elect Donald Trump and House Republicans' deal to suspend the debt ceiling for 2 years might have averted a government shutdown this time, but kicking the economic can down the road is not a solution. It's like finding a crack in the dam and patching it with duct tape rather than fixing the underlying structural flaw. Meanwhile, everyone downstream, i.e., the taxpayers and the global economy, are left hoping the entire dam doesn't collapse. But here's a juicy economic nugget for you: the US has breached its debt ceiling 78 times since the 1960s. 78. That's about once every 9 months on average. You'd think with all these debt ceiling hikes, they would have figured something out. Instead, the U.S. national debt has surged from less than $1 trillion in 1980 to a staggering $33.8 trillion as of December 2024. Pro tip: remember when we said the U.S. economy is too big to fail? Guess what? Too big to fail doesn't mean invincible. It means taxpayers from around the world might have to foot the bill when the empire cracks. Let's move to the real problem here: how the U.S. has weaponized its currency dominance to maintain unsustainable levels of debt. The U.S. government continues to overspend because it assumes it can indefinitely print dollars, borrowing to infinity without immediate consequences. Why? Because the world uses the U.S. dollar as the reserve currency, thanks to the petrodollar system and the trust in U.S. Treasury bonds. But how long can this global financial arrangement hold? According to the IMF, the U.S. debt-to-GDP ratio has ballooned to over 129% in 2024, higher than Greece's during the Eurozone debt crisis. Remember how Greece became the global punching bag for fiscal irresponsibility? Now apply that same logic to a far larger economy. Adding fuel to the fire, the Federal Reserve's aggressive interest rate hikes in 2023 and 2024 to fight inflation have already raised borrowing costs. For every 1% rise in interest rates, the U.S. government adds $330 billion in annual interest payments on its $33 trillion debt. Guess what that means? Less money for infrastructure, healthcare, and education, and higher taxes for Americans. Already, interest payments on debt exceed $700 billion annually, according to Congressional Budget Office (CBO) estimates. At this rate, by 2030, interest payments alone could exceed defense spending. Conclusion: the debt ceiling fight is a distraction from a far scarier reality. Even if Republicans and Democrats come to an agreement, the math doesn't add up. The U.S. is borrowing tomorrow's wealth to pay today's bills, and the hole keeps getting deeper. Now, let's talk about Trump's demands to abolish the debt limit and push his new tax agenda. He claims it's a very good deal for the American people, but who exactly is benefiting here? Hint: it's not struggling middle-class families crushed by inflation and a housing affordability crisis. The proposed tax cuts are a continuation of the supply-side economics theory, more commonly known as trickle-down economics, which has been repeatedly debunked. According to a November 2024 report from the Center on Budget and Policy Priorities, CBPP, the top 1% of earners already controlled 32% of the nation's wealth, while the bottom 50% control just 2.5%. If Trump's tax agenda goes through, corporate tax rates could drop further on top of the previous reductions from the 2017 Tax Cuts and Jobs Act. The result? Corporations and wealthy Americans get richer, while revenue shortfalls leave the government with fewer resources to finance public services, worsening the deficit. Sure, you can argue that corporations might reinvest in jobs, but historical data suggests the bulk of tax savings usually ends up in corporate stock buybacks rather than worker wages or expanded hiring. The potential shutdown before the holidays underscores a growing dysfunction in Washington. According to the Brookings Institution, 2023, the 21-day government shutdown during the Trump administration in 2018 to 2019 cost the U.S. economy $11 billion in lost productivity. In every shutdown, federal workers are furloughed or forced to work without pay, contractors lose businesses, and essential services grind to a halt. But do politicians suffer? Nope. Their paychecks and perks remain untouched. While lawmakers clash, real people pay the price: job losses, delayed tax refunds, and chaos in markets. Ironically, these shutdowns often cost more than the disagreements they're supposed to resolve. It's the height of absurdity. Why does this drama matter outside the U.S.? Because as the world's largest economy, the U.S. is the anchor of global trade and finance. If trust in U.S. fiscal responsibility erodes, other countries holding trillions in U.S. Treasury bonds might start looking for alternatives, placing the dollar's status as the reserve currency at risk. China and Russia have already been pushing for de-dollarization, and central banks worldwide are diversifying reserves with gold and China's yuan. According to the World Gold Council's latest report, global central bank gold purchases hit a record high in 2024, with China leading the charge, buying 350 tons annually to reduce reliance on the dollar. If you're in finance, you've seen the writing on the wall: countries don't trust the dollar like they used to. The U.S. drama over the debt ceiling reflects a deeper truth: both parties are ignoring the elephant stomping around the room. Whether it's Trump's push to abolish the debt ceiling or Democrats chanting, "Hell no," nobody is focusing on real, systemic reform. Ladies and gentlemen, the U.S. is like a person with a gambling addiction, maxing out one credit card and then asking for another limit increase. The longer they avoid rehab, the greater the eventual crash. The solution? Radical restructuring of debt management policies, responsible fiscal governance, and policies that invest in productivity rather than catering to the short-term interests of the wealthy elite. Until then, as Elon Musk rightly put it, despite his own controversies, this circus of incentivized overspending and divisive politics means the American economy is balancing on a knife's edge. The next crisis may not look like 2008, it could be far worse. Everyone, stay sharp about this: the storm is coming, and it's time to prepare. There you have it, folks, another day in the crazy world of economics. Smash that like button, subscribe, and comment below if you've got thoughts on Washington's latest tricks. Until next time, stay informed and stay vigilant.